So in general, this is what CPA firms that you'll see practicing usually do. The title CPA grants certified public accountants with the right from state to state based on what the state says, but generally with the legal right to perform, and not just perform, but to be the person who signs off on an audit or signs the audit letter once the audit is performed. Okay, so actually, most accounting work in and of itself doesn't require a CPA, as many of you know. You can participate in an audit function. You just are not able to actually sign the audit as the accountant signing off on whatever the findings in the audit were until you have a CPA license. But it's kind of the gold standard for all types of accounting work, whether it's actually required to do the work or not. So tax services, advisory services, people usually just like to see the designation of CPA by someone's name, and that kind of just gives them a sense of security and understanding that this person is capable of performing this work, regardless of whether it's legally required for that particular. So this is kind of the structure nationwide of CPA firms. You've got your big four international firms, and obviously these are worldwide, have offices in at least most major cities throughout the world. Each of the big four does, and these are the accounting firms responsible for doing the audits for pretty much all of the Fortune 500 type companies, and then a lot of smaller companies as well. And you've got national firms that will usually have offices in all major cities across the United States, but maybe not as big or not any international presence at all. And there's several more of those. And then you've got regional and large local firms that may just have within the state 4 or 5 offices, or may cover a certain region of the country, maybe cover the Mid-Atlantic region, covering from maybe New York down to North Carolina or somewhere around there, and have 8 or 10 offices in between. So, and then of course you've got your small local firms that could be as few as just one person working as a sole proprietor by themselves, doing various accounting jobs. So this just basically talks about what I did there as far as what. This is a breakdown, as you can see in the chart there. You've got the big four. You've got 4 more firms that are considered national. You've got 4 that are considered regional, and then you've got a couple of large local firms. And you can see how their various revenue is broken down. Over in the far right column, you can see what percentage of the revenue they make off various engagements, accounting and auditing, taxes, or management consulting and other. And they're all fairly even, but you see some like PricewaterhouseCoopers gets the highest percentage of their revenue from auditing, whereas Deloitte has, if anyone familiar with Deloitte knows that they do a lot of management consulting. So you can see that it's kind of flip-flop there, where they get the majority of their revenue from that side. And then on down the board, as you get more and more local, the 2 numbers to the left side, the tax and audit stuff, will be higher, and then the management consulting side will be lower. If you look on this one, you see the large local firm of Berkowitz, Pollock, and Brandt actually have a larger percentage tax and then consulting than audit. I think that's probably more of an anomaly, but generally top to bottom, it's good to see a division that's close to a third of their work coming from audit, a third coming from taxes, a third coming from consulting. Obviously, if you're really built up in the tax area, then you've got some personnel issues during the rest of the year, since the tax area You've got 4 months that are really busy, and then while you may have some tax work throughout the year, it's not going to be nearly to the level it is during the busy season. So ideally, you want to break that down pretty close to these are some various things that the CPA firms do. You see more of the smaller CPA firms doing stuff like general accounting and bookkeeping services. So this would be for entities that are small enough that they don't have in-house accounting departments. And so they'll usually farm out to some CPA or accounting firm, maybe payroll duties, general bookkeeping duties, and then keeping of financial statements and tax services as well. And at the smaller level, those are also the firms or the entities that probably receive the most management consulting services from CPA firms. While they may not bill as such, a large part of what a smaller CPA firm does is going to be kind of value-added benefits to doing the book work. They may contribute some non-billable management consulting type service. These are the factors or some of the factors that influence the organizational structure in CPA firms. And you'll see when we talk about it, like an actual org chart, why that might be important. But at different levels, in a big firm, you're going to have maybe, I may just call them an accountant or an assistant accountant at the lower level, and then maybe a manager or senior and a manager, and then a partner. And so you've got a hierarchy of people that are involved in the various CPA services. And so when you go out and audit a company, you've got your kind of grunt level employees that are the newest people, least experienced. They're doing a lot of the testing and actual combing through the data. And then you've got a senior accountant that's probably, depending on how big the audit is, might be in charge of that particular audit. And then you've got a manager and a partner who are going to be looking over the work that person's done. And each partner will have under them various groupings of people, so that and you'll see when we look at some of these of the laws that Sarbanes-Oxley brought into the books, some of those involve shifting and moving on and off of audits. So you're only allowed to audit a company for so many years, and then you have to move on, and a different company has to do it. And so a lot of that's very similar because you may shift off internally, you may shift off an audit and have a different team do the same audit to avoid some of these same problems. Basically, the longer that you do work for a client as an auditor, the closer, because you got to remember that when you do your audits, you're on site most of the time. So you're there, you're commingling with the employees, you're oftentimes giving them business suggestions. You definitely have interests that are aligned with the clients you're working with. And as the years roll by, sometimes you get and develop closer relationships with the clients than maybe is proper. And so, those closer relationships make you more likely to maybe overlook some improprieties that otherwise you might not. And so obviously you want to avoid any type of litigation that may be tied to that. But you also, the hierarchy is also set up so that you have someone at a more senior level who has more experience than you that you can go to for questions, so that you can always be competent in the services that you provide. So very often for a CPA firm, you'll see either a limited liability company or a limited liability partnership, depending on what state they're working in. Basically, because these give you the protection or liability protection, while at the same time giving you some of the more simplistic features of a partnership, just a regular partnership or a sole proprietorship. So those bottom two lines there are the ones that you'll most commonly see associated with any type of professional services firm, such as an accounting firm or a law firm. And like I talked about, as you move up the hierarchy, you see obviously it makes sense that the amount of experience of these people who are moving up the food chain there gets larger and larger. So as you become a partner, you have more experience, so that those who you manage who are under you can come to you and you can theoretically help them where they run into problems, where your experience would be beneficial. And that helps to ensure that the required competence is met, regardless of whether the people, because obviously you have to start somewhere. So everyone can't start out with having done 50 or 100 audits of this exact same type of client. But if within the firm at a level above you, there is someone with that level of experience, even if this is your first audit of this type of client, you can at least have someone to go to who does have that competence and can convey a little bit of that to you. SOX, or Sarbanes-Oxley Act, is you really shouldn't ever take an accounting class without hearing about the Sarbanes-Oxley Act, just because it's so important. And as you see from this slide here, this is probably the most influential piece of legislation ever in the auditing profession. This says since the 1930s, most certainly since then, perhaps ever. And the vast majority of these provisions only directly affect publicly held companies and their audit firms, but there is a trickle-down effect that affects lower-level companies as well for various reasons that we'll touch on later. Okay, so this under the Sarbanes-Oxley Act, the Security Exchange Commission created this PCAOB, which is the Public Company Accounting Oversight Board, to basically monitor the accounting activities of publicly traded companies and their audit. That's the basic mission of the Securities and Exchange Commission, or what they're set up to do. These are various reporting forms that are required. You'll recognize the yearly annual report, the 10K, the 10Q, the quarterly report. So these are reports that are basically summaries of financial information that include various requirements that the SEC has set. Now the AICPA is a CPA society. I believe it stands for the American Institute of Certified Professional Accountants, or Certified Public Accountants, sorry, brain fart there. Basically, some of the things the AICPA does, it sets professional requirements, conducts research, publishes materials related to services performed. They're empowered to set standards or guidelines and rules, and in fact in the past had an even greater role in setting standards in the profession. They're responsible for some specific auditing standards, compilation and review standards, other attestation standards, as well as a code of professional conduct. And the AICPA has this code of professional conduct. Most state CPA societies have their own code as well. The one that I'm sure that you guys will be, if you're taking the CPA, become very familiar with this AICPA's role in is the CPA examination. That's one that touches everyone who is lucky enough to spend the vast amount of time required to pass those tests. So you'll become more familiar with at least some of the things the AICPA does. In addition to administering the exam, they also provide some variety of prep materials for it. They do provide in continuing education. The statements on auditing standards, it's a classification of statements on auditing standards, and it basically makes up or includes GAS, which is how that acronym is pronounced, which is the generally accepted auditing standards. Now, in the international community, there are different organizations that set the standards. In the financial world, you hear about IFRS a lot, which is the equivalent of U.S. GAAP, but for the international area. And so a lot of different countries have either set their standards to mirror the IFRS standards, or have, like the United States has set a goal to converge with the IFRS standards. So eventually our GAAP and the international IFRS standards will be much more closely aligned, though we're not adopting them as such. So similarly with the international standards on accounting, or on auditing rather, they are obviously set by international entities. Unless a specific country has adopted them in their whole state, they don't necessarily govern anywhere, but they're a set of standards, and the purpose of which is to kind of have a unifying effect, whereby the various countries can look at the international standards, and as they go on refining and reforming their own standards, some companies will adopt outright the international standards if they don't have a lot invested in their own standards so far. But countries like the United States, as they're refining and reforming standards, keep a close eye on the international standards, and try to, or at least in the recent past, have made it a goal to try to converge a little bit more with the international standards, just to make it a more level playing field, to make it a little bit easier to do business internationally. There's just a breakdown of the governing standards or the standards governing auditing for various entities. That first bullet point there is not necessarily international standards on auditing that don't necessarily apply to every country outside the United States, but they are not governing standards within the United States. U.S. GAAP, which for auditing purposes is the U.S. GAAS, generally accepted auditing standards, is what is applicable to entities within the United States, unless they are publicly traded companies, in which case they have to follow PCAOB standards. And the U.S. GAAS is very closely tracking on the PCAOB standards. It's just that the PCAOB has more in-depth. I won't go through piece by piece on these various standards. I will say though, this is one of the favorites of the AICPA on the uniform CPA exam. This is a slide here that no matter what test prep you do, if you're studying for the CPA, this is something that you'll end up having to memorize, at least, if not word for word, at least the basics of this slide. So I won't get too much into that, but it is something that you would refer back to when this is just a breakdown of that previous slide. Standards there. Standards of field work, obviously those are applied to when you're out in the field performing any type of inquiries that you need to. These are when you're sampling the evidence to make your judgment. And then we've got standards of reporting, and again, won't get into those, but this is something that you would refer back to regularly to make sure that when you're doing audits, you're complying. We already kind of went over this a little bit. PCAOB only has jurisdiction over public company audits. The ASB has jurisdiction over private company audits. Again, standards are not terribly different. Just in general terms, PCAOB has more exacting standards because these are generally the companies that have a lot more money tied up with them, and for which investors. Now, the statement on auditing standards is provides guidance to auditors but it basically is the most authoritative piece of reference material you can look at in order to ensure that you are correctly satisfying your duty as an auditor. So it is an important document. These are some various elements of quality control. I won't get into that specifically, but these are areas that you can look at in order to drill down into quality control within the entities that you're auditing. This is just kind of a flow chart. You can see, peer review ties up with quality control standards. It kind of is a circular motion here where one feeds off the other, but you see some cross pollination there where audit practice and quality centers apply to the generally accepted audit standards. So, I'm not sure how much you're going to get out of this flow chart, but you can see that all of those different categories are interrelated and help to ensure that the audits are completed in such a way that they provide the assurances that they're supposed to provide to clients and users of financial and these are just the various kind of hoops that have been set up for CPAs and their firm personnel to jump through, again, to ensure that CPAs are competent, that they are able to perform the work that they're called upon to do, and also to make sure that they're complying ethically, that they are providing the things that need to be provided, and that they are aware of legal liability and have taken steps to minimize it for themselves and for prospective clients.